Hey, what's going on everybody? Alpha Investment Group here today. In today's topic, I'm going to talk about the basics of buying a call and buying a put option. So let's dive right into it. What is an option? An option is essentially just a contract in which you get to buy an underlying asset at a predetermined price up to a predetermined date. So there's two very basic forms of options. There's a put option and there's the call option. You buy a put option when you're intending for a stock or a security to go on a downward trend, in which you are aiming to be profitable on this downward trend. And a call option is a derivative in which you're intending for an upward trend in a stock or security. So when you buy a call option, you're expecting the price to rise significantly. You get to buy this contract so you don't have to own the stock. There are three variables very key in options trading. You have the strike or exercise price, the premium, and the expiry date. So the strike or exercise price is the price at which your option can be exercised. So let's say you want to buy an option and the exercise price is $100. Anything above or below that determines whether you exercise this option. The premium is the price you pay for buying this option. Because these options aren't free, otherwise everyone would buy all of them, you have to pay a premium, which is basically just like a little fee for embarking in these options. And then you have the expiry date. Again, when you buy an option, you can choose the expiry date. They usually go by week to week or month to month intervals. And options can range from very, very short periods of expiry and very, very long periods of expiry. You can buy options that last for years. What you have to understand though is the longer the option date, the more expensive it is. And this makes sense. You're given the luxury of more time to be profitable. However, if you buy a short-term option, it's often a lot cheaper. And the reason for this is because you have a lot less time to be profitable. So let's dive into some examples and some visuals to understand this a little better. We're going to start with the call option and we're going to look at the stock of Amazon. Well, Amazon in the last year has greatly appreciated. Their stock price has gone well above the $1,000 mark and has fluttered a bit around the $1,100 and some change all the way up to $1,200. So let's say as an investor, I wanted to invest in Amazon and I wanted to buy a call option on Amazon. I would look at three things. One is how much time do I want on this option. Again, the longer the time, the more you have to pay. Let's say I want to buy a 6-month call option on Amazon. And let's say I want the strike to be $1,300. The strike or exercise price is $1,300. The time is 6 months. As we stand today, Amazon stock sells at about $1,160. The greater the spread between the exercise and strike price and the market price, which is the price today, the cheaper the option is. Again, when you buy an option, you have the choice to set what you want the strike price and exercise price to be. But the closer it is, the greater the premium. And the farther it is, the cheaper the premium. And again, this makes sense because when you're buying a contract or an option, there's someone at the other end selling you that option. And they're at opposite ends with you. So whatever you believe is going to happen to the security, the only reason they're selling you it is because they believe the opposite. So they're only going to take a deal that's worth their time. No one's going to sell a call option on Amazon for $1,200 because it's already been there. And it's very likely that it can go back up to that. But at $1,300, the gap is a little bigger and there's someone on the sell side willing to go through all that. And again, it depends on the premium and the time. Amazon may well reach the $1,300 mark in the next 5 years, but can they do it in the next 3 months? Maybe not. That's why the time value options are very important to take into consideration. So let's go into the graph to look at this. This green line right here is the strike or exercise cutoff. Whenever Amazon within your time frame goes above that, you are considered in the money. This essentially means that the market price exceeds your exercise price and you are profitable. Now with the call option, you have some discretion. You can choose to sell right now, or you may believe that it'll continue to rise higher and therefore making you more profitable. Keep in mind that you have an expiry date, and anything after that, your options contract becomes useless. So do not make the mistake of forgetting about the date. And here's another example live from Yahoo itself. So these are actual options in the market right now. You have Amazon with a strike at $1,400 and the contract length is a year. And here's the premium. So in order for you to be profitable, Amazon has to reach above $1,400, and technically for you to be profitable also has to exceed the premium. So it's $1,400 plus the premium because you're paying for that contract, and that's when you become profitable. And now I want to talk a little bit about the put option. A put option is very interesting in that you can make money from the price of a stock or security going down. So to understand how this works, first you have to consider that when you engage in a regular transaction in the stock market or the financial markets, you are first buying something with the intention of selling it in a future date. With the put option, what's interesting is you are selling the stock first with the intention of buying it at a future date. So you are selling the stock at today's market price, hoping for it to go down and to buy it at a lower price in the future. And then you profit off the difference. How that works is essentially when you have an investment account on a trading platform such as TD Ameritrade or any other one of the platforms you can open up, and you want to engage in a short transaction, you are loaned the shares from another account. You don't get to keep those shares, but you are loaned those shares in order for you to sell. And within the contract of the put, you have to eventually buy those shares back. Now, the only reason someone would do this is because they expect the price to go down. So if they can buy it at a future date for a lower price and sell it today, they profit off that difference. So let's look at the Amazon example again. Let's say I'm an investor who thinks Amazon stock is going to go down. And let's say its stock today is at $1,160. And I think Amazon is going to go down to $900 a share within the next year. So I buy a 1-year put and sell the stock today from borrowed shares for $1,160. And let's say my analysis and forecasting is correct. And in 1 year's time, Amazon sells for $900 a share. I buy that share by exercising my put and I profit off the difference, which is $260 minus the premium. When you're done with the put option and you're buying the shares, what you're doing with that buy is essentially giving back those shares that you loaned. Now, these financial institutions and trading platforms organize the borrowing of shares. So the person that you're borrowing from, you'll never know who they are, actually is not affected in their account. So you don't have to worry at all about the whole borrowing thing. I know some people get confused about that. What you have to consider with put options is you're looking for a deal where the market price is below the strike price. With the call option, you're looking for the market price to be above the strike price. In both situations, you're profiting off the spread between the two, and the determinants again are the strike or exercise price, the premiums for this contract, and the market price. The premiums on every single stock varies, and the reason for this is every single stock moves in different patterns, right? There are some stocks that are very volatile. The premiums are large because no one's going to sell you that option. They know that stock is volatile. Some volatile stocks may be something like marijuana stocks, volatile biotech stocks, and Tesla, for example, another very volatile stock. On the other end, you have very, very conservative and low volatility stocks. These are usually stocks in the utility section and in the consumer staples section, where they're low growth and therefore their stock doesn't move up and down like crazy. The maximum loss you can gain on a put or call option is just to let the stock expire. Therefore, you pay the premium. As I said, again, the max gain on a call is limitless in theory, but is essentially how high a stock can go. The max gain on a put is when the stock goes to zero, because stocks or any security, their price can't go to the negatives. Once it goes to zero, that's your max gain. So again, in theory, the max gain on a put is always less than a max gain on a call. Something to consider. Options are a very, very complex game. They're probably on the more complex and sophisticated side. A lot of people don't engage in options because of their complexity and their risk factors. It is technically harder to make money off options because not only do you have to be right in your analysis, but you have to be right and you're subject to time constraints. Whereas if I buy a stock and I think I'm right, I may very well be so, and I don't have to be right away or within a specific time. I can hold a stock for 10 years before I become profitable. And this call and put option that I just explained in this video is of the most simplest of the call and put option strategies out there, as well as other derivatives. I will be going over more complex strategies in regards to options and other derivatives. I just want to go over two very basic ones and introduce them to everybody, and that's the buying of a call and a put option. Well, that's really all I have to say about this topic, guys. If you do like these videos and you want to hear more about what we have to say, please give us a like, comment, subscribe, and share. And feedback is always greatly appreciated. Thank you so much, guys. Hope you have a good day.